Although the battle with high inflation continues, some sectors of the economy are starting to experience relief. To give us an update on what we're seeing, we're joined by JPMorgan Private Bank Senior Markets Economist Stephanie Roth. Thank you so much for being here today.
Thank you for having me.
So, Stephanie, can you first start off by telling us where inflation remains high and where it's starting to cool down?
Sure. So we have seen some relief in the energy sector. Retail gasoline prices are down about 25% from their high. So that's good for consumers. They feel a little bit better about the outlook. That said, goods inflation remains a little bit elevated and it's quite sticky, even though supply chain issues have gotten better. So we do think eventually that should cool down the goods sector, but it seems to be taking longer than we would have expected. As for service inflation, that has remained elevated and starting to accelerate even further. That's driven by a solid economy and consumer spending that remains fairly solid, especially on the service side of the economy. A key component there is shelter inflation. When I say shelter inflation, I really mean rent inflation. That has been pretty elevated and rising, and eventually it should cool, but it may take some time.
So, how are we seeing this impact consumer spending?
Consumer spending has actually been fairly solid this year. It has slowed down from where it was, and that's to be expected. And a lot of that's driven by good spending. People bought enough stuff as a result of COVID. Now that transition has turned towards service spending, so spending on food and dining and travel and transportation. So that shift from goods to services has started to play out, and we think that may continue.
Now, one area being impacted by inflation is the housing market. Can you tell us more about that?
Sure, the Fed is aiming to cool down the housing market. It's been pretty frothy. House prices are fairly elevated, and they're looking to cool them down. Now, we shouldn't expect a big decline because there is an inherent buyer there. There's a solid demand for housing. Now, shelter inflation is really driven by rents, and that's a different concept than house prices. House prices are more like an asset, and shelter inflation is really the recurring payments that you're using for rent. And that has been picking up, and that's driven, again, like I mentioned, by a strong economy. Eventually, that should cool down, but it's a sticky component within CPI, and it might take some time.
Gotcha. So, could we expect a housing market crash like we saw in 2008?
No, we shouldn't expect that. That was driven by excess leverage and poor underwriting standards. It's very different today. Leverage is much more manageable, and underwriting standards are much more pristine. What we should expect, though, is housing activity to continue to slow down, and that's okay. That's what the Fed's aiming to do, and we should expect that, along with the economy broadly, to slow down, but we're still expecting a soft landing as a result, not necessarily a recession.
Stephanie Roth, JP Morgan Private Bank Senior Markets Economist. Thank you so much for all of that insight and for being here today.
It was great to be here. Thank you.